Today's subject, we're going to be talking about debt, good debt, bad debt, long debt, short debt, all the debts.
You're listening to the Real FI Podcast, where we discuss time-tested tricks, techniques, and strategies for pursuing financial independence today, so that we can enjoy a better tomorrow. Financial independence isn't about getting rich quick. It's about cultivating a foundation to grow financially, mentally, physically, and spiritually. Let's figure out how to kick the 9 to 5. Here are your hosts, Patrick and James.
How's it going, everybody? Welcome back to another segment of Thinking Out Loud on the Real FI Podcast. I'm your host, James Rippion. I'm here with my co-host, Patrick McGrath. How's it going, Patrick?
It's going great, James. Happy Monday. Let's kick this week off strong.
Let's do it. I'm going to need a strong kickoff to the week. I'm feeling a little sluggish from, festivities and fun over the weekend. So we're excited for a nice, productive week. So Monday's going to be a good start. I think we got a really interesting topic to talk about today. Interesting to most people, who are going to be listening to this podcast because they're financially minded. They want to get their finances right and they want to achieve financial independence. And that's what we're here to talk about. So today's subject, we're going to be talking about debt, good debt, bad debt, long debt, short debt, all the debts. I know that in my personal investing, journey, I've come across a lot of different types of debt and, there's a time and place for it all. So I think it's going to be a good topic for us to discuss and digest and, give some of our own insights on.
Yeah, I couldn't agree more. There's a huge misconception around good debt, bad debt, if real estate debt is good debt or bad debt because you have a note. There's all kinds of different people's opinions out there on debt. And I think we're going to dive into it a little bit here and hopefully help some people pay off that debt, give you guys some ideas on how you can do that and, increase that credit score and get that debt paid down so you can buy more real estate and invest more money. So let's do it, James.
Absolutely. So, let's start off by just talking about what is debt. And that might be a dumb thing to kind of explore, but I think there's ways to think about debt that kind of don't go fully appreciated. Debt is, you borrowing from your future self to buy something today in the present, because you're engaging in a contract essentially to pay more money that you don't have in the future to buy something today. And of course, there's good and bad ways to go about that. Good way, and we're going to call this good debt, buying assets, things that appreciate, things like cash flow. The bad way to go about that, of course, credit card debt, car loans, depreciating assets. So, there's a couple ways to look at it, but fundamentally, it's borrowing from your future self to buy something today. Do you have any other thoughts on what, debt is generally, how you like to conceptualize it or think about it generally?
I just look at it as good debt is something that pays me. Bad debt is something that I pay. And I think if you bring it down to that, simplest form, then that should be, your idea and on how you think about debt. Things like James said, assets, real estate, it pays the debt itself. I'm not paying it. Someone else is paying it. The debt's in my name, but I'm actually not paying it. And then bad debt is something that I'm taking my money, my hours worked, whatever, and then paying off, like you said, car payment, credit card debt, different things like that. I've got to take my earned money and pay that off.
Right.
So good debt, bad debt. How do we get rid of it, James?
Well, let's talk a little bit more about good debt. Like, I think there's some more aspects to good debt. And you mentioned buying assets and things that pay you. I know that, sometimes when you get into investing and things like the stock market, you can actually leverage yourself and get debt to buy assets that merely appreciate. So like you could take a margin loan against, your collateral and your brokerage and then buy some Tesla stock, but Tesla stock's not paying you a dividend, but you're going to have those payments that, are required to keep that loan against your Tesla stock. And that, that might put you in a little bit risky of a position. So I think when you kind of think about good debt, there's two different ways to look at it. You got, on one hand, those assets that you buy with debt that pay you cash flow. That's real estate, of course, first and foremost. It could also be businesses. Maybe you go get an SBA loan and you go acquire a business that's kicking off free cash flow and, buying something like that. On the other hand, you're just buying something that's appreciating, which might be a little bit more speculation, which I've admittedly done. Took out a loan, bought some Bitcoin. That thing is volatile as heck. It's going up, down, left, right, sideways, round in circles. But the kind of debt that I had on that just purely appreciated asset was fixed over a long period of time. So wasn't super concerned about, the price volatility. But I think there's definitely a lot of ways to look at good debt as far as that goes. What are your thoughts on that, Patrick?
Yeah, I mean, I agree on that. And there's all kinds of different, like you said, good debt out there. If you're taking a loan to start a business, to buy your inventory, for some sort of service that you're offering to sell, starting an Amazon business, starting a Shopify business, and you need inventory and stuff like that. That is, in my eyes, good debt, because hopefully if your business becomes successful, it will be paying that loan off and you'll be making a profit margin. So yeah, I mean, I couldn't agree more with you on that. And that's why there's so many different types of debt out there. I mean, and it all depends on how you're using that money. Like a home equity line of credit, is that good debt or is that bad debt? Well, it really depends on what you do with the money. If you go out and buy a new Harley and an RV, bad debt. If you take that home equity line of credit and you go out and buy a rental property, good debt. So it really depends on what you're doing with that money. Same thing with credit card debt. If you use a cash advance to buy some real estate and then you turn around and burr it and pay that card back, I'd consider that good debt. That's a way to access some capital right away. It's not maybe the best way and the first way that I go about doing it, but you're using that money to purchase something that is going to cash flow. So that's good. But if you're just filling up your gas tank with your credit card because you don't feel like spending your cash or you're low inside your checking account, that's bad debt.
I know, Patrick,
so-
I know some real estate investors that have done that strategy you're literally talking about, where they go get a whole bunch of credit cards and they just max out these credit cards. I don't know how it works technically, but they end up buying real estate with it and then, refinancing one way or another to longer term debt. But those kind of things are available, but at the same time, you have to appreciate the risk on the back end of that. Like if you get caught with your pants down, market turns, or the house doesn't end up appraising or whatever, you're going to be stuck with some gnarly debt to pay off on a monthly basis. And no one wants to be in that position.
No. So again, it's all relative to what you're using those funds for. And again, if the debt is paying for itself or not. And I think that's kind of where I stand. But again, you guys can agree with us or disagree with us or tell us we're stupid or whatever. This is just my personal opinion on how I look at debt. So
yeah, as long as you're having an opinion on it and you're thinking about it, that's all that matters. I mean, there's going to be a lot of strategies to go about it, but why don't we talk a little bit, like you were trying to get at earlier, about how do we get out of debt? And I think before we started talking, you said it perfectly. Number one strategy: don't get into debt. I don't know if anyone
get into debt
in high school, like if you ever started the year off by getting an F in a class, and you're trying to get that average grade point up, or you just got whatever, you just got a terrible grade. It becomes so difficult to get back into that A territory. Same things with debt. Like each A you get after that is going to slightly take you from F to D to C to B, but it's going to be really difficult to dig yourself out. So, first and foremost, don't do it to yourself in the first place if you can help it. There's always going to be extenuating circumstances, I guess, but if there's an alternative, pursue that. So step number one: don't get into debt.
Don't
So
get into
more,
debt.
more practically, Patrick, what are some of your strategies for getting out of debt to pay it off? Like, how do you think about that process?
Yeah. So I think my number one, I'll probably get some pushback on this, but I think every single person has 10 to 15% of their income available to pay off debt or to use for investing. And what I did, my personal way of being able to save up money for investing and to pay off debt, was I opened up a separate bank account at a local bank that I didn't have online access to, that I had to physically go to the bank to get the money. And I had my paycheck from my company divert 10 or 15%. It instantly split 10, 15% went to this bank over here every paycheck, and the rest went into my account. So I only spent what I had inside my checking account linked to my debit card. And then it may not seem like a lot at first, but over time, 2, 3, 4, 6 months down the road, now all of a sudden you've got a nice chunk of change sitting over here in this account that you forgot about because you're not even thinking about it. And then you can use that to pay down your debt. And then once your debt's paid off, you can start using that as an investment account. And I know it might be tough at first, but you can always increase. You can start off at 5%, get that paycheck, live those 2 weeks, a month, make sure that your bills are covered, then increase it to 10, 15. I got all the way up to 25%. So I was living off of 75% of my earned income, and I had a pretty high earned income, but I would go and check that account, and all of a sudden there'd be $5, $6, $7,000 in there. Okay, cool. Let's go. I can now use that to invest in my properties. I can now use that to do different business ventures. I can use that to pay off credit card debt, which I have done before. So I'd say that is probably my first and biggest little tip or technique here is everybody has 10 to 15% that they can be using to pay down their debt and invest. They just don't think that they do. So what do you think about that, James? Good idea, bad idea?
I think it's a great idea. I think what you're pointing at is how to mitigate and get around like this human flaw that people have of just tinkering with shit unnecessarily with finances. Because I know like the way you're talking about how you structured it is that you got it out of your control and out of sight and out of mind. And it became a passive automatic thing that just occurred, as time passed without you having to, expend any mental energy to make it happen. So I think that's super valuable, especially for people, who are in debt. It might be a good thing. It might show that you have some impulse problems, so like getting that money out of your control and out of your hands is probably a great place to start. So I think that's such a great way to go about it. I know that when I first started investing, I did the same thing. The money would come into my checking account, but it would go straight out into all the other accounts immediately, and whatever was left, that's what I could live on. But it was funding my Roth, funding 529s, other investment accounts, savings accounts would come in and immediately out. So I think that, if you have the patience to set up that kind of automatic fund transfer, like it's going to be super beneficial to you. I know there's, I don't know if you've ever read this book, Patrick, but it's called Profit First. I read it a couple years ago and probably should reread it now that I'm more into having my own business. But basically it's, as a business owner, you're going to be paying yourself first. A lot of people think about profits as like the last thing that's owed to a business owner or something, but you can apply this to your personal finances too. Like figure out what you just need to live off of, and maybe the rest of everything else goes towards reinvesting in you and personal development and paying off debt and credit card and stuff like that. So identifying where your starting point is, I think is super, super important.
I agree. And, it really comes down to budgeting. But if you got yourself in a ton of debt already, you obviously are not that good at budgeting or using your finances. And there'll be a ton of people out there. Hey, well, I've got a I got a savings account linked to my bank account. So I can just transfer that money into my savings account every paycheck. I don't need this other account. And it's like, yeah, you can. And I'm sure you've probably did that in the past. And then Friday comes around, you're looking at your bank account and you notice the funds are low. So I'll just transfer 50 or $100 into my checking account to get me through the weekend. And I'll put that back when I get paid. And I'm sure everybody's done that. I know I did that. So how do I get away from doing that? Like you said, automatic. It's just out of sight, out of mind. And that's exactly what you just said about profit first. That's what my dad always would tell me. Pay yourself first, take that 10% and pay yourself first. And at first it doesn't seem like a lot, but the old saying, pennies make dollars. And that's a great way to start. All right. So now we got some money coming in. We're saving a little bit. So what's the best strategy on starting to pay off some of that debt, James?
Oh man, there's too many. There's too many great strategies. Everyone's got a lot of options here. So I think there's two ways I like to think about it, and it gives you kind of four options. So on the first side would be kind of the amount of effort you're putting into paying off your debt. So what do I mean by that? Like, are you going to be setting up this monthly schedule so you know exactly what the timeline for paying off the debt is? Like if principal and interest is $150 a month, you're going to make one payment a month for the next 36 months. Or, on the other side of that, are you going to be super aggressive with it? Are you going to start putting, $1,500 towards that payment instead of just the minimums to get it paid off? People, you can think of this like with a mortgage. Some people like to keep that 30-year mortgage, just make the minimum payments. But some people like to pay a little bit extra towards principal, and it reduces the amount of time that you're going to have that loan outstanding. So especially with like credit card debt, like, are you going to just pay the minimum and try to get it taken care of over a longer period of time? Or are you going to be super aggressive with it and devote like every free penny to paying off that debt? I'm in the aggressive camp. Like, I got some debt I'm trying to pay off now. Like, I'm putting every penny into that. And I've been delaying a lot of, purchases in the present just to pay off that debt because it's uncomfortable. And then the second strategy would be like looking at interest rates versus the sum of the debt that's owed. So if you have a whole bunch of different kind of debt, maybe 2 credit cards and then a personal loan, maybe the personal loan's at like 6%, and then the credit cards are at 12 to, I don't know how, 18%, like
20, 25.
Yeah. And then maybe you have, private money loan with a lender for a real estate transaction. I don't know. Like, what would your strategy be with like paying off? And I'll ask you, Patrick, what do you think? Would you pay off the higher interest loans first or the smallest balance loans first?
So I would pay off the smallest balance loan first, specifically because you get that sense of accomplishment. Like, all right, I've checked this one off. So now that money that you were using to pay the minimum or whatever you were doing spread out over, now you can take that money and start paying it towards the next largest one. And this is called the snowball effect. And
this is your idea, right?
Oh, 100%. Yeah, I came up with this just before we started this podcast. Now, this idea has been around for a really long time. But as you pay off these smaller balance cards, you get to see that, you're actually working towards your goals. You get the sense of accomplishment. You get to scratch that one off. And then you start to pay off those larger balance ones with a larger sum of money. So that kind of helps you accelerate like a snowball rolling down a hill. 6 months, 9 months, a year later, you're working with more money than you had in the beginning. And I think that's a really great strategy to kind of start off with. But there's a ton of different strategies out there. One that I really like is if you have good enough credit, you just have a pretty good amount of debt you're trying to pay off. I would look at 0 interest balance transfers. I know me personally, I have utilized that strategy quite well over the last few years. That's where companies will offer you to transfer the balance from a high interest card at a 0% interest rate for 6 months, a year, 18, 24 months, zero interest. And typically they charge like 3 to 5% of the balance that you're transferring over. But this strategy works extremely well on being able to limit that interest that you're going to owe people. What do you think about that strategy, James?
I agree 100%. I think, I've taken advantage of those balance transfers too, and they work well. And it's always got a time and place. And I've used them when I didn't necessarily need to. I guess it's not a balance transfer. I like the 0% 18-month credit card. That's a pretty awesome deal. Get that credit card, you rack up a balance, and then you just kind of hold it for a period of time, and then you can pay it off in the future. Of course, if you're doing that a lot and things are changing rapidly with the economy, and maybe you're stuck with a whole bunch of 0% balance credit card debt after you get fired from your job, like that's not a good situation to be in. So like have some cash reserves available, be able to manage those kind of loans and those credit card payments. But back to like the debate of like whether or not you pay off the high interest rate loans first or whether you go pay off the smaller balance. I 100% agree with paying off the small balance first. And there's a big reason behind that. A lot of times investing and money related issues are a very logical numbers based decision, but sometimes it's emotional. There's a lot of emotional aspects to finance, and I think that can't go ignored. The reason anybody, is interested in finance is probably not because of the money. It's because what money provides. And what is that? That's security, peace of mind. So I think those kind of things need to be appreciated. And I think when you're paying off the small balances, it gives you peace of mind, and it gives you a little bit of security to know that that's done. And there's a huge mental component to that. Because whenever you carry a debt balance, like it just weighs on you. Whenever it's not good debt and you know that your tenants aren't paying it off for you because it's real estate debt, it's like a noose. It's terrible. It doesn't feel good. So having those small victories by just paying off the small balances, that goes a long way mentally, and it's going to be able to help you move forward and keep that forward progress going.
Yeah, no, I completely agree. I completely agree. All right, so here's a little strategy. So, all right, James, once you get that small balance credit card paid off, what I would do is then I would call your creditor, and then I would ask for a credit increase. Now, you're not going to be using this credit card again, but now that the debt's paid off, they know that you're good for it. They've seen that you have made your minimum payments. They look at your account, and you might take a card that has $2,500 or a $5,000 limit, and now say, hey, can I get 7,500? Can I get 10,000? And what that does is that changes your available credit to debt ratio. So when you're looking to invest and you're looking to get a home loan or a rental property loan or something else, they look at that debt to available credit ratio. And this can really help with getting that lower down. And in the bank's eyes, you'll be the perfect candidate for them to lend you some money. So I would definitely do that. I've done that multiple times, and it keeps your number down below 30. And that's where you really want to be. You want to be below 30% utilization on your available credit when it comes to credit cards. That's going to keep your credit score as high as it can possibly be. Yeah, they definitely don't want to see it over 50 or 75 for sure. That just makes your credit tank. What do you think about that idea, James?
I think that's a great idea. I never actually thought about that before. Because I just don't keep a credit card balance ever. Like I will literally pay off every item I buy on a credit card, like that day or that week or whatever. Like I don't think I've ever paid credit card interest, honestly, if I'm thinking about it. Because I've always had like the 0% and then like paid it off. But so asking for a credit line increase is not something I've done, but it's something that I'm going to do after this episode's done, because I think it's a great idea. And especially, not only do you become more credit worthy, but now you're in a better position financially. You're looking for smart debt. Now you got a credit line that you could use to maybe go, work on other investment opportunities. And, that might be valuable to you in that way, rather than just having bad debt and buying, a whole bunch of crap with it. But another aspect of debt that I think is worth exploring is the interest that you pay, and maybe the advantage that you could have of having that debt and that interest payment. So what the hell am I talking about? Why is debt and interest a good thing? Well, let's go ask our friendly neighborhood IRS agent, and they'll tell us. So I'm looking at the IRS website right now. And for anyone who wants to go check this out and see what might be available, A, go talk to your CPA. Like, this is not tax advice, obviously. And B, just be smart about it. But you can go check out topic number 505, interest expense, on the IRS website. And it gives you a list of some deductible, itemizable interest payments that you can kind of, work on your taxes with. And here's a couple of them: investment interest, qualified mortgage interest, student loan interest, non-farm business interest, farm business interest. And here's a big one: interest incurred to produce rents. So that would be residential property, any rentals you have. And then it specifically says there's some types of interest that are not deductible, which, such as personal interest, like your credit card. You're not going to be deducting that from your taxes. So all that to say, like, there's definitely some intelligent ways to manage your debt and interest payments and make that kind of a beneficial thing for your finances holistically. And of course, that comes with smart debt. A lot of smart debt, you're able to deduct that interest from your income.
So is the home equity line of credit on there?
Well, it might depend what you're using it for.
I believe you used to be able to write the home equity line of credit interest off.
I'm not seeing it on here.
I think they changed it. So you used to be able to do that. So before, you could take out your home equity line of credit, pay off some high interest credit cards, with that 4 or 5% HELOC, and then write the interest off that you were paying. So that would have been a good strategy. Now I would even say, how do you feel about going to the bank and getting a personal loan to pay off high interest credit card debt? Is that something that you would do? Is that something that you would recommend?
Oh, 100%. Well, it depends on the interest rate. If you're able to consolidate all your debts, if you got 2 or 3 credit cards and maybe some other high interest loan somewhere, and you can go and you got a good credit score, you're able to go to a bank and ask for a personal loan. You could, refinance all those debts into a, fixed principal and interest payment loan, get a personal loan. And you might be able to get something between, 4 and 8% rather than your interest rate on a credit card. So I totally think that's, a smart and wise thing to do. Especially since you're going to be able to draw out the term on those payments and way into the future. So it's going to be much less of a payment, not only in interest, the amount of interest you're paying, but also the principal. So I think that's a great strategy.
Something that I've done as well. So, I mean, all of these strategies that I'm kind of talking about are all things that I've done to pay off my personal debts. Because like you said, I mean, it starts to weigh on you pretty significantly when it comes down to debt. And now, I'm still in some credit card debt and different things like that, but I use mine for my properties. So basically what I do is I have a couple very high credit limit cards where I will use them to renovate the property while I'm going through the BRRRR process, the buy, rehab, rent, refinance, repeat process on my properties. And what I do is I use the credit card to fund all of the renovations. And then in 6 months, when I refinance, I get the money back, pay off the credit card. So in the eyes of the credit card provider, I'm very stable. they make their money. They see that I pay these balances off every time. And every single time I pay the balance off, I ask for a $5,000 to $10,000 increase. This gets me the points that we used to go on vacations and different things like that. I'm really not paying too much in interest over that 6 to 8 months. Gives you the capital you need to be able to do some things. And then once I pay them off, I have a, large amount of available credit and equity for when I go to buy that next property. So that's a strategy that I use. That's helped me out a lot. But then when you come to, other types of debt, like real estate debt, like we have like over, I think, $1.5 million in real estate related debt that is all paying us every month. So that is good debt. And my goal is to acquire $2.5 million of more real estate debt this year. That's, for us to hit 70 units, which is our goal, we have to add more debt, more good debt. So that doesn't scare me at all. That excites me. The more good debt I have, that's very, very exciting. But
Patrick,
if I was in, go ahead.
I was going to say something I think you should do. You might get a lot of excitement out of this. For all your properties and all your real estate loans, you should take your amortization schedules for all your loans. I don't know if you have them all under one or if you have different ones or whatever, but calculate how much principal you're being paid by your tenants each month. It's an awesome number to look at. And I don't think a lot of investors look at that specifically or keep track of it, but your debt pay down it's doubly cool because A, you're getting paid, on a monthly basis, and B, that's less that you owe in the future, and it's just automatically chipping away at that, principal payment on that loan, and you're going to own that asset, just assuming you let it, go all the way through and pay it off outright eventually. So I think that's a pretty cool thing to look at and track.
Exactly. And that, I believe that's somewhere in like the 3,500 a month range. I went through this I try to do that like every 6 months, just kind of look at it and go,
Yeah.
Okay, cool. My net worth every month is increasing by this much, just paying these loans off. So that's huge. And you also have to look at that when you're looking at your return on your investment and your return on your money, the tenant, the debt pay down, the debt service pay down. I mean, that's huge, especially with inflation as high as it is right now. And you have these long-term, low interest loans. It's extremely beneficial. The cost of money right now is huge.
So
even with interest rates going up.
For sure. And I want to kind of hit on that a little bit because that's like something I'm super interested in, teaching myself about and learning more about it. But, the easy way to think about it is inflation right now is at 7%. Okay. And you can get a 30-year mortgage for close to 3% for 30 years. You got to kind of have an appreciation of what inflation means relative to the debt you have and the interest rate. But you're basically being paid that delta to take out a loan, because what inflation means is that your asset price is going to keep going up at, let's just assume 7%, if that's what inflation continues to be. But you have that mortgage locked in at 3%. You're getting paid effectively to take out that debt. Of course, who knows where prices go in the future, but I think that, it's a super interesting thing to kind of have an appreciation for. And I don't think that we've ever had a situation like that in the future or in the past, as far as like what kind of mortgage you could get relative to inflation. So money is cheap right now, really cheap. You got to be careful. It might be too cheap, and that might be, elements of risk popping up. But I think when you have an appreciation of, how much real return you're making on the interest rate on your mortgage versus inflation, that's a key for a very powerful wealth building strategy.
Exactly. And a little tip out there. So for anyone who is thinking about doing a home equity line of credit versus a cash out refinance, I am a fan of both. But in the times that we're at right now, you have to look, because those home equity line of credits are adjustable rate lines of credit. So typically they're prime plus 1.5. So that means if the Fed is loaning money at 3%, your HELOC is going to be at 4 to 4.5%. Every time, and it's adjustable. So every time the Fed raises rates, your HELOC interest payment goes up and correlates with that. So if the Fed raises rates 4 times this year, like they say they're going to, interest rates could be at 5. Your HELOC payment could be at 6.5. It might not make sense to do something like that. And who knows where it could be down the road. In the early 90s, interest rates were between 8 and 12%. Could you imagine paying 15% on that HELOC that you used to pay off your 15% credit card debt back in the day? So you really have to look at some of these strategies and know how this debt works to work in your favor. So like James said, you can go out and you can get long-term debt right now, lock it in for the next 30 years and be sitting pretty. Or you could go out and do some of these other things that work if you're, looking to utilize that money quick and pay it back with an investment property. That might make sense.
Right.
But if you're looking to, use this stuff to pay off $20,000-$30,000 of credit card debt and pay it over the next 5 years, that might not be the best sound strategy for you to utilize these things. So do your research, make sure that you know the ins and outs of the debt that you're going to. And that's again why James said, make sure you have a good relationship with a CPA, someone you can run this stuff by. Make sure you have a good relationship with your loan officer and you're not just taking a loan off of whoever Rocket Mortgage or, Google puts you as the best person to have, because those guys, they get paid on putting out loans. So you need to make sure that you know what you're getting yourself into. And that comes with time. But I think it all kind of correlates too, because, I know we started with getting out of debt and good debt and bad debt, but you got to be prepared. So once you are out of it, you don't get back into it by making the same dumb mistakes, and then how you can pull yourself out to become financially free.
Absolutely. Yeah. And I think you hit on something important, when with the Fed talking about raising interest rates, interest rates are going to be inversely correlated to asset prices. I mean, you're seeing that with interest rates at the floor right now, assets are going through the roof. So I think that's something to pay attention to. And I'll just leave that at that. But yeah, I wanted to ask you something, Patrick, and this is kind of a specific question. What do you think about canceling credit cards? Because I've done that in the past, mostly for the mental benefit of just not having to think I have that credit card. But I know there's consequences involved with that. But what are your thoughts?
I would never cancel a credit card. Always leave it open. You can keep a zero balance on it.
Just because you have it doesn't mean you have to use it.
Exactly. And they also, like, the credit bureau also looks at your credit history and the length of your credit history. So if you have your first credit card that you got, and you've had that one forever, and you go and close it, now all of a sudden your credit history went from 15 years to 7 years. That's not that good. So I never close any. You gotta watch, sometimes if you have like department store credit cards and different things like that you get when you're 18, 20 years old, because that's all they'll give you. You got to buy something with them, like every 2 years or something like that. So I call and say, hey, just want to know, like, how do I keep this active? So then I'll go in and, spend $10 in there and keep that revolving line of credit open. But I wouldn't do that. And the thing that sucks is, so when you do a cash out refinance, you refinance a property, you're taking out a new loan. So the bank, they send you a letter and say that your loan was paid off, and it goes off your credit report, and then the new loan goes on. So every time you pay off one of these loans, it actually negatively affects you. So I've actually had my credit get hit pretty good because we did like sold 2 properties, did some cash out refinances. Now those loans are gone. And all of a sudden it goes back up in about 3 or 4 months. But now all of a sudden my credit drops like 60, 70 points because I took all of this debt off of my balance sheet, which is hilarious because I don't have it anymore. So yeah, don't close the credit cards. I know it's psychological. But yeah, I would just keep them open.
Yeah.
Keep that available credit, high.
Now, alternatively, like if you've got, and we were talking about this earlier, impulse control issues, and you just feel impulsively like you want to use that credit card, like might be better just to cancel it. Like you're gonna take a credit
cut
hit.
it up. You can cut it up.
That's true.
So you don't have access to it.
Yeah.
I mean, throw it in the shredder, but don't call them and cancel it.
That's a great point.
Lock it up in a safe. Give it to your significant other. Give it to your parents. Say, hey, mom, dad, I don't want to spend this. If you trust them, like keep it for me, and just have it there. And then when you need to go spend that $10 every 2 years, so want to, go over there, grab it, do that. But yeah, I mean, and credit is a huge getting into credit is a whole totally different thing. There's all kinds of different strategies on that, but it's extremely important. And it's funny, but it's easier to get out of debt when you have good credit because banks are willing to lend you money. It's harder to get out of debt when you mess it all up. So yeah, I mean, we could go on and on about this topic, but I think we dropped some pretty good nuggets on this one. I'm sure we're going to revert back to this same thing a couple times on these Thinking Out Loud episodes. Let us know if you guys enjoy these, if we're bringing you some good content. And if you have any ideas on different things you'd like for us to talk about, get our opinions out there. I mean, we'd love that. What do you think, James?
Absolutely. Yeah. Let us know what you guys want to hear. We're happy to chat about them. And let us know that you like this, segment by giving us a 5-star review on whatever platform you're listening to. So we would really appreciate that feedback and that help for our podcast. So with that, do you have anything else, Patrick, you wanted to chat about?
I don't think so. I think we definitely dropped some serious nugget bombs on this one today. Again, hope you guys enjoyed the podcast. Make sure to check out our guest podcast. We're doing 2 of these a week. So if you're not already following, subscribed, all that good stuff, like it, check it out, follow us on Instagram, all that good stuff. And we will see you guys next time.
See you guys.
Thank you for listening to the Real FI podcast, where you learn from the investors that have lived the hard lessons for you. To connect with us during your pursuit of financial independence, be sure to join our community by following us on Instagram or emailing us at info@therealfi.com. If this content made you financially, mentally, physically, or spiritually richer, please make sure to leave us a positive review on your preferred content platform.